大家好，我是梁燕，我们现在就要马上开始周一的直播节目了。KIWISAVER 基金表现，欢迎大家收听。
Good morning, everyone, and welcome to the Monday call. I'm James Grigger, Chief Investment Officer at NZ Funds. It is Monday, the 16th of May at 9 a.m. As we all probably know, the first few months of 2022 have been a tough period for the New Zealand economy. Rising interest rates, falling house prices, and food price spikes are causing real concern, both for Kiwi households and the policy makers tasked with managing the country's book. Economist Cameron Baggery joins us to share his views on the economic outlook, what we can do to get through the turbulence without too much damage, or is there a recession on the cards? Cameron needs no introduction. He has been an economist for 20 years and was chief economist at ANZ Bank for over 11 years. Baggery Economics is a boutique research firm that specialises in independent, authoritative analysis of the New Zealand economy and economic issues. Cameron, thanks once again for joining us this morning. Look, it's probably good timing as well in terms of what's going on the political sphere with budgets coming up this week. And so, look, I'm going to hand it over to you, and it would be great to get your assessment of what's happening, and then perhaps we can launch into some Q&A around some specific aspects of the New Zealand economy. But, thanks again for joining us.
Well, thanks for having me. Look, where do I start? Because there's a hell of a lot going on. If you look at where the New Zealand economy is, or probably was 2 to 3 months ago, we were in the too much of a good thing zone. You have an economy, in the words of the OECD, was overheating. So success, ironically, has its pitfalls and its challenges on the other side, as well as being hit by various supply-side shocks, Ukraine, where you look at COVID. You just have an economy that's too hot to try. House prices were too high, there was too much work out there, and the unemployment rate was too low at 3.2%. So suddenly, I think everybody's now starting to realise that the laws of economics, which were sort of ignored in 2020 and probably halfway through 2021, cannot be ignored. What we're now starting to see across New Zealand is that various pop variables are starting to pop. And the pop variables basically tell us we're on an unsustainable path. Pop variable one is inflation, up towards 7%, and the fear is it could be sticky. The current account deficit, which is like the national checkbook, the money going out the door versus what's coming in, that's back up around 6% of GDP. We're starting to see a lot more lending in New Zealand into the non-bank sector, which on some levels is a good thing, because it's actually driving more competition. But when I start to see non-banks writing about 1 in 10 mortgages, you start to wonder where the credit risk is starting to be transferred. So New Zealand, unfortunately, is facing a little bit of what we call payback, or also I personify the 3 R's. R number 1 is, look, reality is the Omicron boost. COVID was always, the stimulus was always going to be temporary. We're now going through the reset phase. The house prices in Auckland are down 10% from their peak. They're down 6% across New Zealand. We've obviously seen the turbulence across equity markets. That's the reset. And now what we're going through is we're shifting into an environment of what we call real hard work. Welcome to the world where you need to take real risk to make real money, because suddenly central banks, in the form of lower and lower interest rates, have no longer got your back. It's a fundamentally different investing climate, and we're only now, I think, starting to see people start to realise the significance of probably where we've been relative to where we are going to be going future. The market, I think, is starting to remove what's called the central bank put. For 30-odd years, central banks have just rode in on their white horse and sort of rescued everything through lower and lower interest rates. I think those days are done and dusted. So, once again, you need to now take real risk to make real money. Different environment.
And when you think about that from a this week's perspective around government, and you talked about the Fed put or the RBNZ put, when you look at the state of the books of New Zealand itself, is there anything the government can do, and should we be looking out for, i.e. should they be spending a lot more money? And I'm not just talking about increasing things like minimum wage and that sort of thing. Well, that's not them spending money, but you know what I mean. But it's more around capital spending and infrastructure and those sorts of spends. Is that the kind of stuff we should be looking out for, given our debt levels aren't perhaps as bad as those, say, in the UK and other European countries?
Yeah, well, I wouldn't be comparing New Zealand's debt levels to the likes of the UK or the United States, because we're a small open economy and they're pretty big. They've got pretty deep, well-functioning bond markets. So it's sort of like comparing an apple with an orange. Yeah, New Zealand debt levels, though, are pretty low, 35% of GDP. It's on a rising trajectory, though, and we're now getting into that era where the long-term fiscal cost of an ageing population is now starting to bite. So I don't think we're going to be getting debt levels down anytime soon. But we do have a strong government balance sheet, and what does that mean? It provides options, flexibility on the other side to invest, particularly in the long term. This week's budget, I'll be looking pretty closely at what we're starting to see in regard to capital spend versus operational spend. It's pretty obvious it's going to be the biggest operational spend budget we've ever seen. There's $6 billion per year. That's $24 billion over 4 years. The danger is that with inflation, the government decides, no, we're going to have a fixed nominal amount for capital spend. So implicitly, the real value of your infrastructure program over the next 10 odd years could be down by 20 to 30%, because that's been the implicit inflation shock we're going to see over a five-year period. So I'd like to see capital given a lot more of a priority. I think it's going to be an operational spend budget. And it's not just this budget that I'm keeping a close eye on. There is a real dangerous trend coming through budgets where they tend to be bigger spending affairs. We tend to have future budgets all promise austerity, and by the time we get to next year's budget, well, it tends to be a big bang one. Spending your way is not the way to economic growth. Yes, if you invest smart, you can generate economic growth. But what we're seeing across New Zealand at the moment, there's an awful lot of operational spend going out and temporary, some of it questionable stimulus. It's just adding more inflation to those embers. Government actually now needs to rein things in. The OECD's come out and said it. The Reserve Bank of New Zealand is now looking for help from their fiscal mate. Now's not the time for a $6 billion operational budget, but that's what we're going to get on Thursday.
Is that what you mean by 7% inflation, and that's going to be sticky? Because I guess there's one school of thought that we started to have high inflation around this time last year. Maybe it was a bit later in the year last year. And so now you've got some difficult comparative years to sort of that you cycle through. So inflation is going to start naturally coming down. If you do 7% last year, doing 7% on top of that this year is quite hard. But are you saying it's sticky because there's some other things that haven't even started to flow through those inflation numbers yet?
Yeah, well, just step back. I put an article out on Business Desk, would have been at the end of 2020, saying I was taking longer dated borrowing rates because they look cheap relative to the inflation risk profile. And that was 2020. That was before we started to see inflation pick up. What are we seeing driving inflation? Look, some of it's one-offs. COVID logistics, we hope will settle down somewhat. It's going to be intensified or magnified by the Ukrainian situation. But an awful lot of the inflation pressure we're seeing is just a fundamental mismatch between demand versus supply. Demand's been hooving along and supply is constrained. So you've got a recipe for what's called non-tradable domestic inflation. It's not as high as general inflation, but it's still up around 6%. Now, the Reserve Bank's going to try to get on top of that by hitting the economy with lower interest rates. You would actually like the government to try to be a lot more aggressive, stimulating supply. You're reconnecting New Zealand around the globe, migration, labour availability, welfare reform. If we can get the supply side capacity of the economy up, maybe we can arrest some of those inflation pressures. But stepping aside from the economic cycle, the unwinding of the funding of the Fed balance sheet, money printing, that sort of stuff, let's think about some of the bigger picture changes that we're seeing out there at the moment. It looks to be like there's a big balance of power shift within the labour market. what's called labour share of GDP around the globe is now starting to tick back up. It's becoming an environment of all power to the workers. Now, if you look at when we were saying that previously, that was the 1960s, the 1970s. Globalisation is taking a backward step. Now, to the degree to which it becomes a big or multiple backward steps, we don't know. But globalisation is no longer the deflationary force that it used to be. We're going to see a report today at 12 o'clock on climate change. Climate change is going to carry inflationary consequences. Well, the cost of building a home, I think, is going to go up by around another 20,000 just because of these initiatives that are coming in. We're now in an era of bigger, more activist government. We call it the era of monetary policy dominance is being replaced by fiscal dominance. Bigger spending governments going forward around the globe. The whole political landscape has fundamentally shifted. Let's look at the baby boomer generation. The baby boomers were massive savers for a long period. Well, they're now starting to spend. They're hitting that retirement age. So you look at these dynamics, and there's other things in there too, and you start to wonder, are we really going to be able to get inflation back towards 2%? Well, maybe the new normal might be 3 to 4. Maybe the end game here is that as the economic costs of containing inflation became intensively tougher, i.e. house prices falling, unemployment moving up, maybe governments around the globe take the easy card and they just shift the inflation goalposts.
If you were Adrian Orr thinking about this, I mean, he's been a little bit different from, say, the likes of the Fed in the US, where he's tried to go a bit harder, a bit earlier to try and, I guess, then justified by he might not have to increase rates as much as perhaps other economies. Do you think that's been the right approach, and you think we're going to get it under more control than some other economies, or do you think just because of that force of government spending you've been talking about, we're going to see rates up, and then what does that mean for things like mortgage rates and the likes that really affect the consumer?
Well, the Reserve Bank went earlier than other central banks, but they were still pretty late to the party. It's pretty clear early 2021 that we'd superseded expectations. We didn't need the monetary policy stimulus that was still coming through the pipeline. Why on earth do we have the funding for lending program? Liquidity crisis tool without a liquidity crisis. In May 2021, they were still saying the official cash rate wasn't going to be increased for years. 3 months later, they do it on YTU too because they needed to. So the market in New Zealand is pricing in the most aggressive tightening in interest rates New Zealand has ever seen. Now, some of it's a function of real economics. Some of it's actually been a function of a market that's pretty illiquid. So the New Zealand market moved first, and then as the Australian rates market and the American market priced in hikes from the RBA and the US Federal Reserve, there was an absence of receivers within the New Zealand swaps market, so the trading became quite illiquid. So the market in New Zealand tended to overshoot. What do we know at the moment? The market is pricing in the biggest aggressive rise in rates New Zealand has seen. Do I think New Zealand households can handle a 400 basis point increase in official cash rate in less than 2 years? The short answer is no. I think we'll see the economy buckle before then. But the Reserve Bank at the moment and inflation expectations 2 years out are 3.3%. That will be 3 years of missing your target, which is an F for fail. So central banks at the moment have got to talk tough. It's all about their credibility. Now, ultimately, we're going to face a moment where central banks are going to have to pause and do the David Longy stop for a cup of tea. And I guess if you look at what are those conditions for a pause, I think there's 4. One, you need to see headline inflation coming down, just because from a pure presentational perspective, it looks better. 2, you've got to get inflation expectations back in the 1 to 3% band. They're at 3.3 at the moment. 3, you need to see house prices, asset values come under pressure. Well, we've already ticked that box. In fact, we're a long way down that track. And the 4th one is you need to start to see the unemployment rate start to move up. And that's the one that could be a little bit more slow to move, because if you go talk to firms out there at the moment, everywhere, everybody's scrambling for staff. And there's a lot of concern that we could lose people overseas, which could amplify those shortages.
that's a good segue into migration. What's your feeling of what's going to happen there? Because I mean, it's talk at the moment, but it feels like we're going to get a whole lot of people who wanted to do their OE over the last 3 years all leave at the same time, and migration into New Zealand doesn't seem to be as in high demand as it was before COVID. Is that kind of what we're seeing in the stats at the moment?
Yes, if you look at the stats at the moment, the last figures we got the other day, we've had a small net exodus of minus 7,300. Now, it's slightly less worse than what it was at the end of 2021, where it was up around 9,500. But there's still a negative outflow. Now, the anecdotes on the ground is that there's people that want to come. Obviously, there's plans afoot to sort of open up, reconnect. But there's also, you go talk to law firms, accountancy firms, construction firms out there at the moment, they're generally really worried that there's a whole batch of people in their 20s that are going to say, I'm out of here, and off they go. And, of course, as we're reconnecting around the globe, what are we seeing? The recruitment consultants from Australia are going to become increasingly across the ditch here in New Zealand, and they're going to be targeting people. And this is where the combination of a housing affordability problem and inflation that's higher than Australia and wages that are higher in Australia could be real challenging.
And so in the past, if we think about what migration gave the New Zealand economy, there was always complaints even in John Key's days and in this current government around we've got growing GDP, but GDP per capita is decreasing. It's all driven by migration. Is that the reality of what migration was giving the country? And then so without that, with an exodus, we're really going to have a struggling GDP for quite some time until we can turn the tide of migration.
Either that or we play the smart lever and try to get the productivity story up. Yeah, but if you go back, well, New Zealand has been overly reliant upon migration for growth for a very long time. And what COVID unravelled was how dependent we were on that economic story. Not just through a demand lens, but through a lens for firms to actually get the workers. We've seen people have panned the backpackers. Well, the backpackers weren't there as tourists. The backpackers were there as a big mobile labour force around New Zealand. When we were reliant upon migration, I don't think we were seeing enough investment in local talent here in New Zealand. So the business sector needs to take a pretty cold, hard look at themselves in regard to training locally, investing in your biggest resource, which is people. But the big question going forward is what's the potential growth rate of the New Zealand economy? How fast can we grow year after year? That's the key to wealth creation. And if you look at it, it's pretty obvious migration is not going back to 60,000 a year. There's a growth in the working age population, the labour force is not going back to 2% every year. If you get that plus 1% productivity growth plus, well, you're in the 3% potential growth sort of phase. If we look at the past 5-year trend for labour productivity growth, 0.6% per year. Labour productivity growth has not been above 1% any time in the last 5 years, but the 5-year average is 0.6. And if you put, say, 1% growth in the working age population, labour force on top of that, suddenly you've got a potential growth rate that's sub 2%. Now, that number really matters because if we cannot grow as fast, the Reserve Bank's got to hit the demand side of the economy an awful lot harder on the other side. So I'd like to see a real big pivot, not just within the government, but businesses realising we need to go helplessly harder here in regard to driving what is the big key to wealth creation, which is productivity growth. And the trends, if you look at them, are not flash.
Can you define, when economists like yourself talk about productivity, what are we actually talking about, and then how do you flex that, and how do businesses and governments flex that to increase productivity?
Well, here's a classic one. It's well known, the quality of our infrastructure around New Zealand. Well, it's poor, and COVID has exposed how poor it is because all the ships are no longer coming in to all the ports. So now we've got to whip the stuff around by the trucking network, and the network's just not that as efficient. By the way, how many ports do we actually need across New Zealand? By the way, let's have a look at the education sector. Well, the education sector is probably the most important barometer of where New Zealand is going to be 30 years out. Not just in regard to producing people that are going to be on the labour force, but how smart good they are. How good and smart do you think the kids we're producing today, when we've got declining school attendance and we've got declining achievement? You're seeing all this attention on truancy and the link to these RAM rates and these sort of things. Now, I could go on and on about the productivity growth, but when you break it down, it's really simple. It's just it's the efficiency of those factor inputs, such as capital and also labour. How smart are we at using those resources in an efficient manner? On some levels, when you go down to field days, for instance, and you have a look at what's going on there across the agriculture sector, there's some real amazing stuff that's taking place. All the drones walking around the farms and the 12-year-old kids operating the drones. There's all these sort of funny things that are going on. But if you look at, unfortunately, the productivity statistics we're seeing of late, they're not showing improvement. They're showing a slowly deteriorating trend.
What's a good comparative country? Does Australia have much higher productivity than New Zealand or the UK or US or Europe?
Yeah, typically you got most economies that got a number with a one handle in front of it. And New Zealand used to have a one handle in front of it. We've now got something with a 0 point in front of it. And that's some of it. New Zealand suffers because we don't have the scale of a whole lot of other countries around the globe. And so we need to be doing things an awful lot better in regard to the regulatory, the policy framework. But if you look at the regulatory, the policy framework at the moment, it's hardly what you would call, encouraging people to get out there and invest in the real productive stuff. I'll give you another example. The Reserve Bank, when they brought in the rules for banks to have to hold more capital, what do banks do? Well, they suddenly decided to lend more into the housing market because you need to hold less regulatory capital. So suddenly a policy, well, it's good intention, had unintended consequences in regard to we saw home lending go from 58% of bank balance sheets to 62% of total lending in the space of 4 years.
And housing is one of the least productive assets of the economy, really, other than, I guess, it helps with consumer spending when people feel like they're making money by house prices going up.
Yeah, well, maybe this is the big reality wake-up call for New Zealanders at the moment. Because if you have a look at the ratio of house prices to income in New Zealand's up around 11. Now, to get house prices back down to where house prices were relative to incomes in 10 years' time and pre-COVID, house prices need to grow at 0% per year for the next 10 years. Now, is that going to take place? The answer is no. But what it serves to highlight is that if you look at the economics of housing, you're off the charts. If you look at the politics of housing at the moment, you're into that politically dangerous zone as well, where politicians cannot afford to let history repeat. Now, so I step back here and think about if interest rates are going up, say interest rates are no longer going to be in a downtrend, say there's a slight uptrend, obviously a bit of it front-loaded, what does housing look like as an investment for the next 10 years? And certainly not as flash. Where people are going to have to start to think about making their money, I come back to what I said at the start, taking real risk. That's what you need to do in a rising different rate interest rate environment. It's about adding to your assets. It's about, generating assets that actually generate pure cash flow. Massive, implications here for commercial property, farms. Everybody's played the low interest rate card.
It's an interesting one because when you think about housing and productivity, and what's going on with perhaps migration, the fact that there's this exodus, you can get pretty bearish. And then on the other side of it, part of what Ukraine, I guess, has caused the world is this food crisis, and how ongoing that is. We're still probably unsure, but New Zealand is in a strong place with our export markets, especially around dairy, and perhaps we do we underestimate that in the sense that our biggest export is linked to oil prices, which is going up dramatically and actually really helping with those terms of trade? Or is that just not enough of a driver of New Zealand's economy, perhaps that it once was?
Yeah, that's a really good point. Like, I mean, if you sit back and you think about it, COVID probably helped identify some much needed appreciation for the rural heartland across New Zealand, because we're one big farm and the world needed to eat, and we kept the supply chain actually open. What we're also seeing now in an inflationary environment is that if you're a low-cost producer, which New Zealand is, you're going to be better placed. But you're not going to like what's going on because inflation is potentially eroding your earnings. But we're seeing an awful lot of pressure around the globe of peripheral producers. But you've got to set the question about whether they can survive. The glass half empty view of that is that, are we going to re-enter a world based on subsidies and protectionism? Because food is just an essential. So suddenly that the world becomes very unlevel in regard to the playing field for essential items such as food, and the jury is still out here in regard to where we're going to go in regard to that. You turn it to New Zealand's terms of trade. New Zealand's terms of trade, which is the ratio of export prices to import prices, has increased around 45% in the last 20 years. It's a compound growth rate of around 2.1% per year. What does that mean? The price of food, what we sell overseas, has massively risen faster than the price of stuff we bring in, i.e. the manufactured stuff, goods, particularly the stuff out of China. And that's been a big source of economic growth for New Zealand. It's been one of the reasons the New Zealand dollar was trading an awful lot higher consistently over a long period, because it was supporting the current account, it was supporting living standards. Now, I'm undecided at the moment. I'm still trying to get my head around it. What is the outlook for New Zealand's terms of trade over the next 10 to 20 years? One of my fears is that what if that ratio, after surging 45%, now starts to go down? Political reality bites how much people can pay for food, but this current bout of inflation means manufactured goods become the really inflationary goods. When we bring in the manufacturing goods, so you start to think about, what does this mean for the terms of trade? Maybe it's lower, not higher. What does it mean for fair value for the Kiwi dollar versus the US dollar? Probably lower, not higher.
Do you think that's what's driving the Kiwi at the moment, or is that more just an interest rate differential and what's going on in the US rather than anything to do with terms of trade? Because it's been quite a big move in the NZ dollar over the last few weeks.
It's been all about the US dollar. You have a look at dollar yen, you have a look at the Australian dollar as well. The currency that I'm keeping a close eye on in regard to repitching New Zealand's fundamentals is the Kiwi Aussie. The Kiwi Aussie was up there. We were consistently in the 90 zone, and not necessarily the 90 zone for quite a while. Now it's suddenly the low 90s, and it looks like we're going to see a break. And maybe history starts to reassert there that suddenly fair value for the Kiwi Aussie is now back in that 85 to 88 zone, as opposed to the 90s number I think people have got used to for the past 7-8 years.
And the Aussies don't really have the same issue around, I guess, food exports and some of the pressures that might come in with protectionism, etc., because Aussie, the lucky country, they're sitting on a whole bunch of commodities that no one else has, and so their terms of trade can actually increase even with an increasing price of manufactured goods that they have to import. Is that kind of a good way to look at it?
A couple of ways. Structurally at the moment, I think Australia is just in a better space, at least within a 5-year time frame. I'm seeing too many cracks in New Zealand's economic story. But if you sit back and you think about, look, New Zealand is long overweight renewable resources. Where do you actually want to be? Overweight renewable resources. Like Australia and a fossil fuel climate change world, they've got some deep-rooted structural problems 10 to 20 years out down the track. So there's going to be a little bit of pay in the pipe within that very long-term sense within Australia as well, which probably caps how much of an adjustment you see within the Kiwi Aussie. But New Zealand became a little bit top dog for a long time, and a lot of the reason we were top dog, migration, these sort of things, we're never going to be self-sustaining for a long time. New Zealand just feels like we're in a little bit more of a payback zone versus Australia over the coming 5 years.
Yeah, it's an interesting one because it's they've always been saved by that high carbon commodity driven economy, and I wonder if they're going through their own sort of thought process around what needs to drive their economy going forward, given changes and especially around environmental legislation, which seems to be on hold at the moment, given the cost of energy overseas. All of a sudden no one likes carbon credits and they've sort of fallen out of bed in price, but it kind of feels like it's still here to stay, and they are in real trouble with some of those rules.
Yeah, well, we have a look at what's the biggest concern to households in New Zealand at the moment. It's inflation, cost of living. Climate change is number 7. Right, so yes, we're going to get some announcements out today, which is we need to embrace them and go down that path. But, we're going to get told this news is going to be more inflationary, higher cost of living at a time households are already getting, there's talk about the middle income poor group coming through New Zealand as well. That's going to make it politically challenging in regard to how you deliver what actually needs to get done. But I guess the simple rule here, there's no free lunch.
One of the hopes as COVID sort of normalised and borders open was tourism. Any views on how that's going to rebound? And there's a lot of discussion around having really high value tourism. I don't know how you quite change it other than attract people by only having business class flights, because how do you actually stop backpackers coming if they want to come? But that's the part that's always confused me around the makeup of your tourism client, is that it's demand driven, isn't it? But how do you think tourism plays out in New Zealand post COVID?
I think tourism faces a very long, hard road back.
And is that global?
Yeah, not necessarily global. New Zealand is just a lot more distant from anywhere else. And I'm thinking of my own overseas holidays. Now you got to put this within a risk management framework. If something goes wrong, you actually don't want to be too far from home so you can actually get back. And particularly if you've got families. So suddenly the whole idea of the Chinese market's going to take a long time to reconnect. Now, China's in lockdown. They're our biggest market, at least dollar amount, not dollar amount, but they're the most important amount in regard to average spend. The tourism market in New Zealand's been supported for a long time just by cheaper and cheaper flights and greater accessibility. And more airlines in New Zealand. How long is it going to take to rebuild that capacity? I suspect the answer is a long time. Structurally, I wonder whether the tourism sector in New Zealand is going to have the same product on the ground. If you can't get the same people, you're going and staying in a nice hotel, you actually want all the restaurants open. If you can't get the staff, you can't get the top chefs, what's your service offering there? So we're seeing down in Queenstown at the moment, look, the hotels are operating at limited capacity, and it's not because they don't have demand. They do have demand for the likes of the school holidays. They actually can't get the people to actually run the facilities. And this is where the backpackers, like reconnecting with that part of the market, is going to be really critical going forward. So if I have a look at the net, because people tend to overweight tourism. They think about it just through people coming in lens. But you got to think about the people going out on the other side. I suspect New Zealanders are going to be reconnecting to the Cook Islands, Fiji, Australia faster than what global travellers reconnect into New Zealand.
Yeah, I guess that then puts what was tourism as a percentage of GDP before COVID?
Well, tourism, so if you look at international tourism, which is the number that was being thrown around, and it included education, it's about a $17 billion number. Now, you throw in domestic tourism on top of that, you got something up around 30 odd billion. The problem with that $17 billion figure was that it didn't net off what we spent overseas. So if you look at the net contribution of tourism, it was actually not the big heavy hitter that was being thrown around, i.e. 5% of GDP, because as soon as we couldn't travel overseas, we started to plough money into the domestic economy. So net tourism spend was about 2 to 3% of GDP. So these comparisons that tourism was as big as dairying was not correct when you look at it through a net lens.
And so that's interesting. So when you think about it, it's difficult for the companies involved in tourism. They are getting absolutely hit hard by lockdowns and things. But as a sector as a whole, economy as a whole, actually, that's why we really haven't seen that slowdown in GDP. So having it come back is another way of looking at it. Having it not come back is important though, because the net number could get really quite negative, because if we start all travelling but no one comes to New Zealand, I don't know if we're all going to start travelling or not, but I assume people will start going to the islands and Fiji and things.
I don't think the net number will be a large improvement. There's my instincts at the moment. And you have to look at there's still a whole lot of people are not going to travel overseas for a long time, but some people will. What we saw post-COVID was we saw a big collapse in what New Zealanders were spending overseas because we didn't travel. Now, do I see a lot of that money play out into the domestic tourism market? The answer is no. I thought a lot of that would get played in domestic travel because everybody rushed down to Queenstown, all these sort of things. What we actually saw was that people who sold cars, people who sell motorhomes, people who sold spa pools actually hoovered up an awful lot of that offshore tourism money that got diverted into the domestic economy. It was almost like the New Zealand international tourism market was waiting for the international door to be back open, as opposed to getting out there actively pitching. There's a big domestic pool of cash here we can actually tap into. Let's go real aggressive for that. So I think from memory, we saw a pick up in domestic tourism spend of about $1 billion. And I think offshore tourism spend from memory was about $9 billion.
Right. So not, very small percentage.
Yeah. Now, New Zealand was shut down, locked down for parts of that. So you're never going to get all of it back. But it just gives you an idea. And look, you all know the anecdotes about if you couldn't go to Europe, what did you do? You went and bought a new car. Suddenly, you couldn't take that overseas trip. So there's $20,000 to Johnny or Jenny to help them out in their first home. Upgrading the carpet. The spa pool anecdotes were absolutely rife. A lot of that offshore money just got ploughed into other parts of the domestic economy. What's going to be interesting is what happens to those other parts of the domestic economy in the next 6 to 12 months if we start to holiday again.
All of a sudden, people aren't going to Bunnings in the weekend; they're going on holiday.
Yeah, it's those big tickets items. The anecdotes, so the demand for the motorhomes, these sort of things, and you were seeing it around the country. People just, instead of going on a holiday, they went and bought a motorhome, and that's what they did.
Cameron, the final topic I wanted to discuss with you, and it would be amiss if I didn't, given I'm a Kiwi and this seems to be what we all talk about at the dinner table, is housing. And you've touched on it a bit about how we've already seen a fall, but a little bit of crystal ball here, but I'm pretty simple when I think about it. I look at our favourite sort of mortgage rate, which is the 2-year fixed mortgage, and where's that going? And that's going to have a pretty big detriment, I would have thought, on house prices. And it doesn't feel like that 2-year fixed rate has stopped yet in terms of increasing. Is that a way to look at it? And how do you think about housing and what's going to happen? Not the productivity side, just generally house prices.
Well, if you look at house prices in general at the moment, you've got a losing quinella or a losing quadruple. You've got rising interest rates. Credit is an awful lot tougher to get. The supply-demand dynamics around New Zealand has shifted fundamentally in Auckland, and you got the government policy tax changes, which if people now start to scroll through, when you can no longer claim that tax deduction, it makes a big difference to what the bottom line numbers actually look like. So suddenly the allure of housing, which was trading at what can only be described as quite scary multiples in the first place, you got an asset price that's in a pretty dangerous zone. Now, the glass up full is that, well, if we start to see anything become systemically problematic, the Reserve Bank has got the tools to deal with it. They can lighten up and loan-to-value ratio restrictions. The market will no longer price in such an aggressive interest rate cycle. But if I go back to what I talked about earlier on, taming inflation is not growth or asset price friendly. And now we're in the rubber hit the road sort of phase where we've got a lot of inflation. And are we going to be prepared to wear what could be a pretty harsh economic adjustment on the other side to get that inflation genie back in the bottle or towards 2%? Or are we going to end up in an environment where it becomes too hard and we shift the inflationary goalposts? But the housing market, Auckland, it's down 10% mark the market from November last year. That is a far deeper adjustment than what we saw during the GFC. And it's still early days. There's 170-odd billion worth of fixed-rate mortgages that probably fixed this time last year around 2.19% with that ANZ rate. What are they going to get? 4.5%. So your mortgage rate doubles. Now, if you've been around a long time, 4.5% is still low. It's double what your first mortgage might have been. So it's a double your mortgage cost. Actually, what you need is more than double the money because the money you need to find is after tax. So suddenly you've got a completely different trajectory in play for the housing market, and the Reserve Bank needs to be very careful here.
Where do you think that number could get to, that 4.5 now?
Well, the market was assuming the official cash rate could go to 4%. It's backed off from that in the past couple of days as interest rates have fallen a bit. But if you had a typical 1 and 2 year fixed mortgage rate margin on top of that, you're talking rates up with a high 5.
That puts a lot of pressure on that sort of incremental house price.
Well, you already see like the 5-year rates are still up around those sort of levels. Now, those rates are still low, but one of the things I'm thinking about is what's the neutral interest rate in New Zealand? What's called the neutral official cash rate, which is where the Reserve Bank's neither got the foot in the accelerator or the brake. So that number the Reserve Bank estimates to be 2%. 10 years ago, it was 5.5%. What if it's no longer 2%? Same with the US Fed funds rate. I think that's 2 to 2.5. Mm-hmm. What if neutral interest rates start to gravitate up over the next 10 years, just like they've gravitated down, and actual interest rates with it over the past 20? And maybe you then end up in an environment where actual interest rates start to gravitate up, not just because of physical official cash rates, but because central banks need to have the official cash rate in a higher zone to actually do their job.
It's an interesting one because at the same time we've had a question around sort of housing affordability relative to income. The market almost might do it for you if incomes are rising because of inflation and house prices are coming down. But I guess that's a good thing in some ways, but also painful for the economy as that adjustment happens.
And traditionally, inflation has been pretty good for the property market, including commercial property. So we're that's one of the reasons I don't like to bake in excessive crash collapse stories within nominal house prices. I'm quite happy to put a big number on the table in regard to how much I think real house prices will fall. But if the replacement cost of building a house is up 18% this year, but that actually adds incremental value to the existing stock. Because if it adds an awful lot more, if the cost to build is now prohibitive, I think we're going to see building consents tail off pretty sharply in the next 12 months. All of a sudden, that building
not going for it anymore. Yeah.
Well, that building that you had in the pipeline, you just got a consent for, where now you're getting the estimates done, and odds are the builder's not going to give you a firm price. And irrespective, you need to put in a number that was 20% higher than when you first put the consent in. And for a lot of people, that just takes that project into the unaffordable zone. And by the way, it's tougher to get credit.
Well, Cameron, we've jumped around a lot this morning, but that's been really, really appreciative in terms of the different drivers of the economy. I think we're going through certainly a change because of what is happening on the inflation and interest rate front. And the overlay of what's going to happen this week with more government spending doesn't bode well for the inflationary environment, that's for sure. And so, we appreciate your comments around how we should think about this. You said something at the start, and I'm going to repeat it because it's, it fits into our mold, but, you can't just sit there being fully invested in a passive market and hope you're going to get the same result as you did in the last 10 years, because it's not going to happen this time around.
Yeah, a lot of people are looking at where we're going through probably a glass half empty lens, and you can put a glass half empty lens around because it's going to get more difficult. But the glass half full is people that know how to take real risk, and active investment strategies are going to outshine passive over the next sort of few years. Getting a lot more normalcy back into the market is actually a good thing. The people that are actually good at what they do will do well over the next sort of few years. All that's going to go on is that we're going to shake out a lot of those people that just really, were only really around or shone brightly because of lower interest rates.
Well, thanks again, Cameron, and we'd love to get you back in a few months' time just to talk around how we're tracking. But until then, good luck with the crystal ball gazing, and have a great week.
You too. Thank you.
Yes. The last thing I wanted to cover this morning for the last 10 minutes was what's going on in some of the markets that we talk around to some extent on the Monday call, and that is cryptocurrencies. As you know, NZ Funds was the first to invest in first KiwiSaver fund and perhaps pension fund globally to invest in cryptocurrency back in 2020, where we entered Bitcoin at around 9,000 and exited in around March 2021. I think it was around 55, 60,000. We exited in March 2021 and saw quite a big sell-off at that point, perhaps a bit more of a steady sell-off than we're seeing now, but it did go down to around the levels, if not slightly lower than what we're seeing at the moment in terms of the Bitcoin price, and that's a good, representation of what's going on across the market. The Bitcoin price and all cryptocurrency prices then rebounded quite strong until the start of this year, when interest rate increases were having an effect on all assets, not just cryptocurrencies, but across a lot of the asset classes, including and especially technology companies. And the reason for mentioning this trading strategy is that is a really important and integral part of what we do at NZ Funds when it comes to cryptocurrencies. I think for those of you who are long-time listeners of the Monday call, you'll know that we have a great affinity to digital assets. We think they're going to be big disruptors in the financial services market and then move across a lot of other sectors and be a big part of what happens in technology and the economy going forward. Needless to say, most central banks are thinking about how they can release their own digital currencies because of this uptake and the use cases of crypto and digital assets. But at the same time, we have always acknowledged that it's incredibly volatile. And while we might have long-term, very bullish price targets around different digital assets, there are periods of time where we do not want to own it. And that is because the volatility of the asset class means it's untenable to have big positions in the portfolio. And that's the case with what's happening now. We've been very alive to the fact that interest rates are increasing. And you'll see in the income portfolios, we've outperformed dramatically versus the benchmark because of rising interest rates. That's had a big effect on technology companies, and that's a good representation of that is the NASDAQ. And so we've done a lot to mitigate that sell-off in technology companies by not owning technology companies, and some portfolios being short some of these non-profit tech companies, which are more susceptible to interest rate changes. And it has also meant decreasing our exposure to digital assets. Where we stand at the moment, and before this big sell-off that we had just a few days ago last week, our positioning in cryptocurrencies in the growth portfolios was about 2%, and so 2 to 3%. So those positionings were very small. Most of those were in shares, not the underlying assets. We do have small exposures to Bitcoin and Ethereum, but those were placeholders for the asset class, and certainly while they've moved around in price, not having very much effect at all on the performance of the portfolios. It is also, and that strategy has also allowed us to take the opportunity to re-engage with the asset class when we think the damage has been done. We even added last week a very small amount to Bitcoin and Ethereum, given where the price has got to. And given the sell-off in Bitcoin especially is really idiosyncratic. Yes, it's wrapped up in what's going on in interest rates and technology, but the volatility we got last year was really to do with what is going on in a specific asset class called stable coins. Now, stable coins are often backed by the US dollar, but there are some stable coins that are backed by Bitcoin or backed by digital assets. And the algorithms that control those really, it's really up for grabs whether they can actually work or not. We've done a lot of work on those alongside Galaxy Digital, and they've always been of concern to us given the nature of the algorithm and the backing not being the actual US dollar. And so we've been nowhere near those sorts of asset classes and have not invested in any stable coin. And so what is pleasing is we've been able to mitigate the volatility in the cryptocurrency space once again. And we now have the dry powder to re-engage with it once we see the momentum start again within the asset class. It's probably going to take some time. It's probably going to take a little bit of time for some of these interest rate moves to flow through the asset class as well. But what we are certain of, that over the long term, cryptocurrencies and digital assets will always form part of our growth portfolios. But being an active manager within that is really important. Because of the volatility, and where we stand now, we think we're in a good position to generate further returns from it as those digital asset prices stabilize. To give you some insights, while last week was quite dramatic within digital assets, when I think year to date, the Bitcoin price is down 33% year to date, which is a dramatic decrease. But it's actually not that much more negative than the NASDAQ, which is down 25%. So really this is a technology sell-off to do with interest rates. But perhaps even more important is non-profit tech. So think about the NASDAQ, and the main components of the NASDAQ are companies like Apple, Google, Microsoft, all profit-making companies, all with very high cash flow and no debt. In fact, they have billions of dollars of cash sitting on their balance sheet. They're technology companies, but they don't move to the same extent as your traditional technology companies that don't really make any profit because they don't have that same sensitivity to interest rates. And so what we look at is non-profit tech. Those are the tech companies that don't make earnings. Zoom, which we're all talking on at the moment, is a great example. Really strong growing revenue, not much profit. And those are the companies that really get affected when interest rates increase. Now, the non-profit tech index is down 50% year to date. And that is far in excess more than what's going on in digital assets. And so you have to put it into context of what's going on. It's a great headline when you think of what's going on in digital assets, but there are companies out there that are generating revenue that have done very well last year, that have given up all their gains since the bounce back of COVID. from COVID. And so that is where the real pain of the economy is being felt. And I think the important part of that is there's going to be some real opportunity within that non-profit tech basket. Some companies will fail, but some companies will bounce back, and there's a real opportunity to re-engage with those companies at a much cheaper price. I'm not necessarily saying Netflix, but look at Netflix for an example. They have 250 million customers, and their share price is 60% cheaper than it was just a few months ago. And that's the same with what's going on in Bitcoin and digital assets in general. There are going to be winners and losers, but there will be some within the ecosystem which we think are really attractive and others that we don't want to go near. And that's where we're focusing our revenue within the asset, our research within the asset class. So to summarize, very small positions in digital assets in the growth portfolios. The growth portfolios are still positive year to date. They're nicely positive due to different asset classes other than just shares that we're invested in. The KiwiSaver growth is up around 6% year to date, and that's versus a market that's down around 15%. And so we're really pleased with how things are tracking. We're really pleased with how the type of investment strategy that we have and the tools that we have at our disposal to manage this type of market environment are working. And as Cameron Baggery said, this is the time where being an active manager is really important. And this is the time where being an active manager can be really profitable for returns. And so we're going to keep plugging away, keep working hard, and keep generating those returns that are different from just a volatile share and bond market. On that note, thanks everyone for joining us this morning. Hope you have a great week and look forward to speaking same time, same place next week, where we're going to summarize the budget with a guest who has quite a lot of